on the participants, just in case anybody wants to join. Okay, so the first thing I'm going to do is put everybody onto mute, just so that we don't get any other sort of odd noises coming in. So I'm just doing that now. If you'd like to ask a question, obviously you can do that at any time. Just click into the participants box and it will give you the option of raising your hand. Alternatively, you can pop a message into the chat box. So that's the one that looks like a little speech bubble. Just bear in mind that if you do type a message in there, unless you select a name, it will automatically identify everyone, in which case obviously don't put anything personal in there. If you've not already done so, if you can make sure your screen name is reflective of who you are, that would really help me later with the Q&A. And you can do that just by clicking on the three little dots that are alongside your name or your image and rename yourself. Additionally, you can change the number of people that you're seeing on the screen, as I just mentioned to Robert. So at the top of the gallery of images, you've got some little boxes. And if you click on those little boxes, you will change who you're seeing, or you can turn people off so you don't see people. And finally, well, as in you want to concentrate on the presentation. That's what I actually meant.
Okay.
And then finally, I'm recording the presentation so that then we can share this with anybody who wasn't able to join us. So I think that's it from me. So over to you, Robert.
Hi, good evening, and thank you very much for joining us. This is the first of our webinars to clients. So we have been through it. Please be kind and bear with us because it's a new thing. And if it works well, then we'd love to do some more and meet and share with you. And because we can do that quite quickly to get messages out. So yeah, bear with us. As you know, I'm Robert Stringer, and I'm here with Richard Mann, and David's joining us on the mortgage side, just in case you have some questions, because as we discussed a little bit earlier, just a minute ago, he's extended the stamp duty, which is fantastic, and also the mortgage guarantee scheme for 95% mortgages. So as Anne says, that's really quite important for those of us wanting to get our people onto the property ladder. So David's our expert on those, and if you want to ask any questions, he can be there. Charlie's here as well, and she's on our administration. So if you have any questions on admin, Charlie will answer those because she's brilliant at that. So anyway, welcome. We're going to talk about tax planning today and some key areas that potentially you need to think about before the end of the tax year. So that running up to the 4th of April, 5th of April. And essentially, it's about the loss of exemptions and allowances and how important they are to use some of these things in what we do, because if you lose them, if you don't use them, you lose them. And they really work well in what we do as financial planners and in many other elements which we'll go through in terms of inheritance tax, etc. So it's about tailoring solutions using allowances. This should last about half an hour, and then hopefully we can have some questions and answers. We'll keep an eye on the chat as well to see what's going on. Next slide, please there, Alison. Okay, so that's sort of the role, that's us. That's what Richard and I and David do in terms of our role as an advisor. So we're looking after your personal and your business interests, looking at your assets, and then really planning ahead for the future. We tend to look medium to long term in terms of investment solutions, and that then tends to bring into using allowances, cash flow forecasting. So we're trying to sort of build a plan, picture of where you want to go to, and those sort of things work well. And in the meantime, if you look at the cogs, we'll use pensions, we'll invest money for you using savings. Those tend to use allowances, and estate planning, again, those looking at inheritance tax planning. And within that, Richard and I are involved with other professionals. So we have solicitors and accountants, and although we have a knowledge, we have to have a knowledge about the things taxation. We really would like clients to be talking to accountants and solicitors, particularly with will writing, getting your estate planning right. And if you're local to us, then using the local solicitors and accountants that we know and would recommend as part of everything we do. So it's really important to get it right, because particularly with things that are complicated like inheritance tax planning, the crucial thing is to speak to the lawyers to get it right, and to get your wills in place. Really important that those are in place when we start it's a bit like not putting oil in the car, having a will. And these days we tend to talk about powers of attorney as part of what we want to do in terms of financial planning. So although people don't often think about power of attorney at this stage, it's important to think about that whilst you're well, because it becomes really complicated if you're not well. I think I'm going to hand over to Richard now. So to talk really about these times, and these times are, what are they, Richard?
Taxing
times.
Good evening, everyone. Thank you very much for joining us. Really appreciate it. Alison's in control of the slides, so I'll be trying to do my very best Jonathan Van Tam and say next slide if she's not keeping up, but hopefully she'll keep up with me and move forward. So taxing times. So although we give this holistic approach to our financial planning, tax and tax planning is always integral to the whole advice process. So it's always important to approach taxation on a personal level, because we're exposed to tax in so many different ways. But we all have different goals, we have different aspirations, and of course we all pay tax at different levels. So income tax, always important, always an integral part of planning, but also we've got to look at capital gains tax, or CGT, as we're going to keep using these abbreviations, inheritance tax. These are all important parts of your planning when we're looking at your journey, where you are and where you're going. So there's lots of different solutions. We see them all the time. You see the Jimmy Carr schemes and all these things that have happened to celebrities, etc. Sometimes there isn't an easy way out. So it's just about understanding what your exposure to taxation is, understanding your reliefs and exemptions, and if possible, use them as effectively as possible. Once we know what you're trying to achieve, we can adopt those strategies moving forward. So yes, today appropriate. I'm not going to linger too much on the budget. Obviously happened today. Whatever your opinions on it, for our planning purposes, issues such as capital gains tax, inheritance tax, tax relief on pensions, etc., haven't changed. Yes, there's freezing of personal allowance, etc. I know certain clients might be here who are here today. Extension of the rate relief, additional support for self-employed are potentially quite important as well. So one of the main themes I got across from the budget was this constant concentration on getting our carbon footprint down, having a green agenda. And that is very much now being adopted by St James's Place. Our new investment director, Rob Gardner, is very, very strongly focused on getting our carbon footprint down, and all our fund managers now have signed up to the United Nations Principles of Responsible Investing. We believe that's the key to future investment and investment prosperity, and making your money grow as effectively as possible. So we're very much in agreement on keeping, this whole green agenda. So what are our allowances? We all know the one to say to use it or to lose it, and the tax year end is the 5th of April. So the cornerstone is to ensure we look at all of your allowances that we can easily use and be aware of. So the first of our ones, always a bit simple, ISA, individual savings account. It's simple, but it really is an important allowance to use. As you know, or you may well know, you have £20,000 of ISA allowance. And your four main types of ISAs are cash ISAs, which Bank and Building Society, stocks and shares ISAs, which is where we come in, innovative finance ISAs, not highly overutilised at the moment, peer-to-peer lending, and lifetime ISAs. And the lifetime ISAs are a really interesting one, especially if you have young people, children, grandchildren looking to get on the property ladder. You know, the 25% bonus from the government they give you every year, effectively, you put in 4,000, the government put in another 1,000. Yeah, it's the best one they've ever done. So definitely, if you have children, grandchildren looking to go on the property ladder, do make them aware of lifetime ISA. They're a great benefit. But predominantly, our focus has always been on cash as a nation. And I think about 81% are invested in cash, only 90% stocks and shares. But it's making sure, is cash the right investment? Can it keep up with inflation? So the decision we have, do you go stocks and shares? Do you go ISAs? And I think the main issue with stocks and shares is this perception of risk. Because once you go out of the building society, it's perceived more risky. And that's totally understandable. So whilst stocks and shares ISAs may sound, you know, that you're just exposed to equities on the market, you can also basically blend them with other assets. You can have commercial property, whether you think that's good or not, gilts, corporate bonds. So you don't necessarily need to be totally exposed to equities, and you can actually tailor a profile that suits you and your attitude to risk. So if you're more cautious and want to go into a stocks and shares ISA, it doesn't necessarily mean it's all stocks and shares. We can introduce other assets that can perhaps produce a bit more balance and don't necessarily react as volatile as in such a volatile world as stocks and shares can. But again, use it or lose it. Please be aware, ISA is a great thing. So what's next? Tax efficient planning. Okay, so obviously when we're looking at working with you, we're looking at, as we said before, all your particular allowances. So looking at all your exemptions and using things like capital gains tax allowances for unit trusts and discretionary fund managers, looking at other investment wrappers, such as investment bonds. How can you take an income from those tax efficiently? Do you go onshore? Do you go offshore? Solutions for trustees. And of course, there's always pensions. You know, we know we get tax free from contributions, but it's making sure they fit in with your overall planning, your overall portfolio. Things such as using dividend allowance, the first 2,000 your dividends are free of tax. So again, be aware of that and use your capital gains tax allowances. So that's the main thing. So next slide, please, Alison. The first time I said it. So what's the strapline? Saving for a pension is hard, but retiring without a pension is a lot harder. So it's really a case of making sure if we're planning for our retirement, we've got a goal, we've got a strategy, we know why we're doing it. Slide, please. Thank you. So one of the main challenges we have now is that we're all living longer, which is brilliant. And I think they're saying now that a third of the children born today will reach the ripe old age of 100. So
that's 14.1 males and 18.8% of females born in 2020 will live to 100. Yeah. And it jumps up massively when they look at the figures from 2048 to sort of over 50% of people that will be living to 100.
So the importance there is two things really. Shifting demographics. You know, we've got more and more retired people and less people working, and therefore we've got to make sure that that puts pressure on the state pension, as you can imagine. And we've got to make sure that we're saving outside to ensure that we have this longevity. And the key for us is making sure your funds last a lifetime. So it's making sure we really do plan why we're saving, but not just for now. It is for this 100-year journey, and hopefully more. Be great. Okay, so obviously pensions are fantastic. We've got tax relief, etc., but the cost to the exchequer is increasing. It's significant pressure. So what they've done is stopped us putting in as much, reduce what we can pay in. For example, the annual allowance, if you look at this slide, in 2010, we could put in £255,000 into pension. You know, 10 years later, we can only put in 40,000. Okay, about 4,000 is if you're already drawing a pension. So it's significantly less because of the tax reliefs. Because, you know, with the tax relief, you pay you get tax relief at your marginal rate. So it could be 20%, 40%, 45%. So it is a big pressure on the Exchequer, which is why now it's been reduced to 40,000. You can use up previous years, and we could do an exercise called carry forward. So if you feel that you'd like to make a pension contribution that's more than 40,000, we can look with you to previous years, going back to last tax year and the 2 tax years before, and sweep up any unused relief. So it is possible to put in more than 40,000, but we need to do that calculation, which obviously we're more than happy to do with you if you like.
One of the good things about the budget is that he hasn't then taken away the 40% tax relief, which is what was always being threatened, and then that they might reduce tax-free cash. So although these 2 allowances are still there and they're not indexing, that is positive news. And in terms of when we look at advice guidance, we would always look at pensions first because of the tax relief and then the inheritance tax planning side. Richard, why do pensions get such a bad publicity?
I think there's two major issues. One, mis-selling, I suppose. It's always been one of those things that has been in front of papers, mis-selling scandals, transfer scandals. There's all various things that they've been perceived to be,
And how do you deal with it?
Effectively. And the other, sorry.
How do you deal with it when people say my business is my pension?
It is to many extent, but to me, a pension is an income retirement. It should be multifaceted. It could be your business, sell your business. It could be these structured pensions. It could be ISAs, and it's about combining them all and having a plan. The key is having a plan. And the pensions are great. They're very tax efficient, but unfortunately, the opportunities are less and less, which is why we have to be, very, very careful that we utilise them as much as possible. So one of the other things that they've stopped us or reduced is the amount we can actually put into a pension over our lifetime. And as the concept says, lifetime allowance. So again, in 2010, you could build up a fund of £1.8 million. Now the allowance is 1.07731, which obviously trips off the tongue nicely. But we've got to be aware when we're planning, what happens if we get to that point? How do we ensure that we reduce the level of taxation? Because the lifetime allowance charge is 55%. Now, you may say, well, I won't take more than 1,073,100, which is fine. But still at 75, they come back and they recheck it. So we need to be aware of that. And when we're planning with you, we need to be very, very conscious of the effects of the lifetime allowance. Again, that hasn't changed. It's been frozen, I believe, in the budget.
It has, yeah.
Okay, so why should I invest in pension? Obviously, tax relief, 20%, 40%, 45%. Tax efficient growth. A pension is a very tax efficient vehicle. 25% tax-free cash at retirement. Again, this is saying that I get phone calls before the budget. Are they going to take away tax-free cash? And it's always muted. Every time there's a budget or an autumn statement, they're going to get rid of tax-free cash. Well, they haven't yet, and it is one of the major incentives for savings or pension. So if the government want people to save, you've got to have some incentive to do so. You have flexible options for a tax-efficient income. Gone are those days when you have to buy an annuity. There's other options. There's drawdown. There's unsecured pension fund lump sum. There's different ways of drawing. But again, the key is managing the tax and don't draw more than you need. We draw what you need and we plan, because there's no point paying tax and putting it in building society. So again, careful planning ensures we draw what you need more than anything else. Inheritance tax exempt. Pensions are very, as we say, tax efficient, but they don't form part of your estate for inheritance tax. So again, should we draw on the pension first or not? So those are, again, questions we need to ask. So it is an important part of our strategy, and we'll always bring those in. But yeah, before the end of the year, you can use up your current annual allowance, and if you need to, use up previous allowances. Next page, thank you. So 4 pillars, okay. ISAs, great, we love them. You don't get tax relief on the way in, but we've got taxable income, tax-free income, tax-free capital when you go out. So it's a good part of when we're building your income, we have a pillar full of ISA income, which is brilliant because it's tax-free. Then we start looking at your personal allowances. So that's when the pension comes in. Pension's tax efficient on the way in, but taxable on the way out. So again, it's a case of where does that fit in with your income strategy and your 100-year life plan. So those are the main ones, but there are other ideas like VCT, which is Venture Capital Trust, Enterprise Investment Scheme, EIS. Now these are government incentivized schemes to try to encourage investment into small startup companies. It could be in infrastructure, it could be in small IT development companies. But the fact is, you've got the tax release, but it's quite a speculative investment. So it's one of those things that we look at as part of your tax planning, but we have to be very, very conscious of the risk profile, because it's, it is high risk, which is why you get a tax relief in these things, which is why the government are trying to incentivize us to invest in our future. So next please, Alison. So I'm not going to go into too much detail, but the Enterprise Investment Scheme, Venture Capital Trust, you're interested, talk to us about them, but we've got a tax reduced on at 30%, so it's quite a strong incentive. But you have to hold them for at least 3, or in the case of VCT, 5 years. You can get tax-free dividends in the VCT, so that could form part of your retirement strategy. And also with the Enterprise Investment Scheme, you can defer capital gains. So sometimes it's somewhere you could put your gain and defer paying the capital gains tax until a point in the future. Never, if you don't cash the EIS in. But again, it's saying that if you're coming up to a gain or you're making a sizable gain, have a discussion about it. It may not fit your risk profile, but we need to talk about it.
And we can also use them in inheritance tax planning, because with these reliefs, that you can hold them for a period of 2 years, and then it's one of the quickest ways of getting through your inheritance tax. We'll touch on that in a minute, but those sort of vehicles can be used for that. But they are speculative, and we will always bang on about speculation in these type of things.
Higher risk.
High risk.
It's got to be your particular appetite for risk, and that's key. Everything has to be tailored to what you are. As much as you've got these fantastic ideas, it's got to sit right with you, and that's the key to us understanding where you are and where you're going. Okay, so the next fabulous taxation is IHT, another abbreviation, as you probably know, inheritance tax. Okay, Roy Jenkins in the 80s described inheritance tax as a voluntary levy paid by those that distrust their heirs more than they dislike the in the revenue. So many people don't do anything, and the only people that actually benefit are in revenue. So it's important that we always have a nod and plan effectively for after the 100-year lifestyle. We're going to do this 100-year lifestyle. So really, really important to start with a good will. And again, as Robert said earlier, we've got solicitor contacts locally. Do talk to your solicitors, get the will started, or get the will done, and then we can build from there. So it's really, really important to do. But as much inheritance tax planning as we can do, one of the main issues is everything increases in value. Your property does, hopefully your investments do. So every time you look at reducing your inheritance tax, everything increases. So it's something it's a moving feast. We constantly say, what's it looking like, and constantly review what the liability is. So changes to legislation. Next slide, please, Alison. Thank you. So you're probably all aware now, over the last few years, people have been talking about this 1 million nil rate ban. So effectively, how much could we pass on to our loved ones, which on the second death, because inheritance tax is always on the second death, without paying inheritance tax. And the band now is 1 million, but just putting a little bit of context on that, please. Next slide, Alison. So we all, and you may be aware, have an individual allowance of £325,000. That is basically what we can transfer to another person, effectively a child, should we say. without paying an inheritance tax. Over 325,000, the tax rate is 40%. So in 2007, Alistair Darling then said, okay, hang on, you can transfer that to your spouse. Bearing in mind that inheritance tax is always on the second death when you're married or in a civil partnership. So effectively, what would happen is on the first death, unless you made provision in your will for it not to happen, your 325,000 passes to your partner and they have 650,000 as an exemption. In addition, what was then introduced was a residence allowance against your primary house. So, but this is a primary residence that you need to be passing on to direct descendants, predominantly children. If you without that, you don't actually get the primary residence allowance. So just be aware of that. Now that is 175,000 each, which is by my maths 350. So we go 650, 350. There's your £1 million. So effectively, there's where this £1 million exemption is coming from. So when we're looking at your situation, we're constantly aware of your property value, where your investments are, and what do we need to do when we get to this £1 million mark. Also, just also so you're aware, once your estate increases over 2.3 million, this residential relief starts to go down. So again, and it's pro-rated down. So just be aware, this £1 million exemption is there, but if your estate is quite large, that exemption will start to reduce. So there's lots of ways we can look at inheritance tax planning with you, and lots of different ideas, but things that can be done immediately that some people just really are not always aware of, is there's various exemptions. So, for example, we have a small gift exemption, so you could give away £250 to an unlimited number of people. And obviously,
walk down Berkhamsted High Street and do that, couldn't you?
Yeah. I'll be first in. I'll be standing there first in line to get them. So yeah, £250 per person. But you also got this annual gift exemption, which is £3,000. If you haven't done it last year, £6,000. So again, you can do that every year. It's not inside your estate. You don't have to wait 7 years. It's magical 7 years or anything else. Wedding gifts. And one we like, obviously you can give it to charity. One we like is regular gifts from income. It's a really underused exemption. But again, immediately falling outside your estate if you feel that, effectively you've got excess income.
Goons.
Yeah, gift out of normal expenditure. Goon. Remember it.
It's the most flexible one, really, isn't it? As long as it's not out of capital, and as long as you make notes of it, and for example, you could pay school fees or regular somethings, then it's a really flexible exemption for each year. And unfortunately, I had a client very recently where all of a sudden it's become an issue, and these exemptions are really important because particularly the 3,000, that if you don't use it, you will lose it. And then, if you have an issue, that to use these gift exemptions every year, because they are there, and yeah, they're there to be used. Really, really important.
Yeah. So I think the biggest thing people say, if I give money away, when's it fall outside your estate? Generally, it's a 7-year clock. But these exemptions, they're not. The 7-year clock doesn't apply. So certainly, if you're talking to, you're thinking about your own estate or your parents' estate, and they're looking at ways, well, we don't want to necessarily, lose control of our money, but we want to give stuff away, but we're worried about doing so, make them aware, or we can make them aware of these various gift exemptions. So basically, another important aspect of inheritance tax planning is the use of trusts. Now, fundamentally, we can all gift money. Effectively, you can give someone £200,000, lovely, which would be really, really nice, and you live for 7 years. It's outside your estate, which is great. Trouble is, sometimes you need that £200,000, or you're not particularly happy giving it to even you're a child because of other things, divorce, whatever. So the biggest issue is gifting, you lose control, and gifting, effectively you can't use that asset. So trusts are really powerful tools whereby you can gift, but you can retain a level of control, at least over how that money is spent. You can be a trustee and basically ensure that nobody's entitled to that capital. It can't be taken away. So it's a base, but the advice on type of trust is really, really important. Appointing good trustees is really, really important, and making sure you're aware of the beneficiaries. So again, it's something that, we've got to be quite careful, how we set those up. So our approach, next slide please, Alison, is really making sure that when we're looking at your estate planning, we use the trust effectively. We look at gift exemptions. We also have various schemes whereby you can gift money. For example, we have what's called a discounted gift plan, whereby you can gift a sum of money into a trust. It's out, you get an immediate discount. After 7 years, the remaining gift is outside your estate, but you retain a right to income. So again, if you feel you have an asset you don't need, but you need the income, something like a discounted gift plan is a great idea. And also business relief solutions, whereby we design a portfolio of AIM shares, which is alternative investment market shares, which actually fall outside your estate after 2 years. So it's a great way, again, to reduce that value of the estate, which is a key thing to reducing inheritance tax. But business relief solutions, potentially slightly high risk again. So to summarise my bit, ISAs, yes, ISAs. We love ISAs. We think they're great because
they are cool.
Yeah. Make sure you use your personal savings allowance. You have that, your personal savings allowance, use those. Pensions, of course, if you want to maximize your allowance, if you want to make any ideas about making a larger contribution this year, please, please get in touch. We're more than happy to do an exercise for you. Use your capital gains tax exemption. So you've got unit trust. It's a good idea. That's a great investment to use a CGT allowance. And make sure if you like dividends within that pension and ISA, they're tax-free. So again, it's a great thing. But overall, let's look at your inheritance tax position. Make sure you're using your gifts and anything else. So that's my bit done. Thank you for listening to me. That's over to you, Robert.
Thanks very much, Richard. That was splendid. So I think, with tax year planning, it is about using those things that have advantages and not losing the exemptions. So and some of those things don't actually cost us any money. And I think just from the budget, from our financial planning point of view, so although he's capped things like the lifetime allowance, but he hasn't taken anything away from, say, tax relief, I think that's positive. But moreover than that, I think it's important that overall there's positivity out there in this horrendous time we've been through, and we obviously know, we've all heard about the amount of debt that has been accrued that we will need to pay back. But they're looking to invest, they're looking to make things happen. And I think that's positive. We have this amazing vaccine coming, their rollout is just incredible. And we have to be proud of something about at the moment. And I think that we should be proud of the fact that has been rolled out and it's positive. And I think that we will get back out there and we will all be back in those restaurants and pubs and spending. And because, we feel for all of those industries that have been affected adversely. But I think that when we're given the chance, we will be straight back out there and having those super meals and things and spending money. So I think it will be positive, and I think the bounce back will be strong, and I think the UK economy will be okay. And that's a feeling I get from the budget. So and luckily they haven't taken anything away, so we're quite pleased with that from that point of view.
I agree. I think the UK is going to be is very positive. It's really good value, especially on the UK equity front at the moment. Now Brexit is sorted of sorts. The UK, it's been in the doldrums for some time now, but there's some very, very good companies in the UK market with a bit more stability, and they look good value for money. So I think the UK is going to be a positive place this year.
Okay, so if anyone's got any questions, we have a couple in the chat. How regular did the gifts from income need to be? So gifts out of normal expenditure although it works well when it's regular, and I gave the example of school fees, it doesn't have to be monthly, or there's no actual regularity about what you give away. So it could be once a year or not, but it has to be out of surplus income, not out of capital. That's the difference. And with all of these exemptions, write them down. If you have a book, or if not, let us know, and we can put it on our CFR, so that on our details. So it's always good to write everything down, but it's a great exemption. And we will send out these slides as well. So if anyone wants to have copies of the slides, and also the budget, we'll have it's a load of stuff will come out tomorrow, which we can send out to you. And Leo's just put there, what's defined as surplus income as opposed to capital? So pension, or whatever your income is, 20,000, you only spend 15,000 a year, you've got £5,000 surplus income. If you save that and it becomes capital, then that's okay, because you can evidence it. But what we're saying is, if you've got 200 grand in the bank, in the savings, but you don't have surplus income, you can't give away that 200 grand, otherwise it becomes a potentially exempt transfer, or under the other gifting. So it's got to be, if you're doing it, it's got to be out of surplus income. We have to sort of show that, because the Inland Revenue may well, or the HMRC will come and ask you, ask the estate to have a look and see if you've made gifts, and you may need to prove it, which is why it's always best to write it down. So yeah, which is why we look at income and expenditure. So if I have a client wanting to do gifts out of normal expenditure, we will check that to make sure that it is surplus income, not capital. Having said that, you may save £5 grand a year. That's surplus income. As long as you spend it in that year, I think that's acceptable to define that. Anybody, any other questions, want to put their hands up, or should we stop sharing, then we can see everyone and see whether anyone wants to have a chat? Can have a general chat.
I can stop sharing, but you might end up seeing the picture of Millie again.
That was lovely. Millie's beautiful.
Well, she is beautiful, yes, but not everybody wants us to see her. Another question has just come in from Tony Jones.
For a married couple, one high rate taxpayer and one is under the tax allowance, is it possible transferring tax allowances between each other? Yes. Yeah.
Sorry, I jumped in there, didn't I?
No, go ahead. Go ahead.
10% allowance you can transfer across. Yeah. So yes, absolutely.
Yeah, usually I send them along to the accountants and they sort all that bit out. I think it's how they do it, but yes, you can do that. And we have clients sometimes we say, if for example I have a rental property, you know, who's it against, who's paying, where does the rental come in, and they've got someone who isn't a taxpayer, and you say, oh, just make sure you have another look at that one. So that's often a good thing to do before you do your tax return, is just to have a look and see, is anyone, you know, a lower rate tax, and is there anything that can be done there? Good question there, excellent.
I've got a question, if that's okay.
Yeah, of course.
Okay, this is possibly slightly off-piste for the purposes of the presentation, I'm not sure, and I don't really understand it, if I'm honest, but there's been a lot in the press, you know, since we properly left the EU about the city, and that Europe, the continent, the EU is preventing us operating as a fully fledged financial centre as we used to. So that would seem to me to be quite a worry going forward, and I don't know if that's something that we should be concerned about. You know, it's fine for everyone to spend all the cash they've got, but that's sort of the bigger picture as the UK as a real financial centre.
Yeah, I think because recently there was Amsterdam, I think, was being mooted as being a centre, or as important as us, I think. I suppose I'm not qualified to be able to answer that, other than I just know that they will do what they need to do to continue being a hub and making the changes and having contacts in the centres that they need to. I do think there will be a bearing, because and that's why, you know, say Amsterdam is becoming more important. But long term, I think in 10 years' time, we wouldn't even notice all these things. There's so many things that need to be sorted out, and we won't know the answers yet.
Sorry, I was just going to chip in there, Robert. Sorry to interrupt. One of the things, I mean, the truth is no one knows, Anne, but one of the advantages of Brexit is whilst we're not part of the EU, as far as banking, and banking accounts for quite a lot of the Exchequer's cash in each month in terms of the profit that financial services make, is although we're not necessarily going to be a hub, we will be able to trade with other global partners. So I think the thinking is that, you know, any potential loss in revenue in the short term will be made up elsewhere. But obviously we'll have to wait and see that.
Yeah, it just feels like we're being really slow to act and react at the moment. So
yeah, it seems to be a little bit of handbags, doesn't it, effectively, because as I said, Amsterdam's overtaken us in volume of trading, and the fact that they didn't negotiate this equivalence deal has caused some platforms to cease to exist. But, you know, the Governor of Bank of England said, you know, effectively, you know, they want to support the UK system, and, you know, the noises are that, you know, we're looking to get this sorted, but yeah, it's difficult to know at this point. So effectively, I mean, the UK is still a major financial services centre. Your investments with us are global. Your fund managers are truly global. We have a global approach. We have a UK equity fund manager based in the US. So it's relevant to us as a country, as a financial service provider. And I think we have that prestige, and we're opened up to the rest of the world as well. So as you know, I appreciate there's some negativity with these issues, which I hope will get sorted. But with regards to investing is truly global now. And you know, all portfolios are very globally focused, etc. But I haven't got the answer. I think we're waiting for the answer, but I think it's just one of those other things, like from the fishing and everything else, it still needs some ironing out, definitely. I think to think that we can come out of Europe, they negotiated for long enough, and it all to work smoothly, I think, you know, was a big ask. But I think I'm hopeful that we will get it sorted, because it's in the best interest of everyone, isn't it?
But financial services is such an important element of the UK, and so people will be on it. We can always ask at SJP and see what their view is. We can ask them what they think, because it is so important to the UK in terms of what FS brings in, financial services brings into the UK. So they'll probably be thinking, but we'll see if anyone knows. We'll see if anyone knows the answer.
Right. I mean, I'm just hopeful there's a load of activity behind the scenes that isn't in the public domain yet. Perhaps that's it.
Probably.
Can I just interject, because it's 7:15 now. We've got one last question there from Bev Turner. How much are grandparents allowed to gift on marriage? You said less than parents.
2,500, I think, isn't it?
How much?
I think it's 2,500.
2,500, yeah.
Yeah.
Okay.
All right. Yeah. So parents can do 5, grandparents 2.5. Anyone else, I think, is
1,000.
Yeah.
Okay. Are there any other questions, or otherwise can I suggest that we wrap it up?
Unless
I
people
can
want
stay
to
here all evening and chat if you like, but I'm conscious that people probably want to get off and go and get their dinner.
Yeah, I mean, I just say thank you all for joining us and bearing with us. It's not something that Robert and I are used to doing. Robert probably is more than I am, being a theatrical type, but you know, thank you for your attention, everyone, and hopefully you got some stuff out of it.
Yeah, and Alison being Alison will send you a feedback form, and so it'd be really useful to know whether this was good for you, and then therefore we'll organise again, because if it is useful, then we of course will do it, and we'll have other topics and things. Online stock trading sites such as eToro have become popular. Do you have a view on the benefits or pitfalls of online stock trading? It just depends on whether you've got regulation, you know, what you're trading, and the sort of stocks and whether they're real, and what you, and it's always, our view on these things is always about risk. So Bitcoin, for example, and anything where you're trading derivatives or when you're following an index, you know, it's just a matter of knowing what your risk is and whether you can afford to lose the money or spend the money, and also who's running that online stock trading. So, for example, I would use the Share Centre, although they're now an Interactive Investor, for my own stuff, but I know where they are and I know who regulates them, and so that's always the important thing. If you want to dabble in something, even if it's Bitcoin, and it's money you can afford to lose, then go for it. And say, you know, with stock trading sites and things, you know, if it suits you for a certain thing and it's safe, but that's always the risk. You need something that's FCA regulated in the UK, because when it goes wrong, you've got somewhere to go to. And our view, and the view of who we work with St James's Place, is that we invest for medium to long term with portfolios of where we have lots of investments. We're not dealing in tiny stocks. We're not, so therefore it's always a matter of avoiding that risk.
It's a huge amount of due diligence, and, you know, as I said before, we've got this 100-year journey. We want to make that money last, and I totally get, if you're interested in share trading, absolutely. A lot of people are, and they do their own thing, absolutely fine. Our remit is, we're pretty cautious. You know, we do like to spread and as far and wide and be diverse as possible. We want the due diligence. We want to know the fund managers are doing their job. They've got to do their job, and if they're not, we'll get rid of them. So it's about making sure, have we got the right strategy, this 100-year journey, and being as safe as possible, making sure your money's safe with segregated accounts. Your money's not held by anyone. It's all held by independent custodians, and really just ensure we have that long-term view. But yeah, absolutely. If you fancy doing some trading, great. You know.
Yeah, but always with money you can afford to lose, just in case. That's the view. It's a bit like anything. Anyway, yeah. Hopefully that answered it there, Tony. Thanks for the question. A great question.
Okay. Thank you very much, everybody. I can see that a couple of people have had to go already, so I think we will wrap it up now. I will send out an email, as Robert said, and obviously, if anybody's got any further questions, then feel free to give us a shout or drop us an email tomorrow. Okay.
Lovely to see you all. Thank you so much.
Thank you very much, guys.
Nice to see you.
Take care.
Bye bye.
Bye bye.